What happens if Japan and China sell off their U.S. bonds? Could this trigger a financial storm? For decades, U.S. Treasuries have been the backbone of the global financial system. Central banks, institutional investors, and governments worldwide have purchased trillions of dollars worth of U.S. bonds, viewing them as a safe haven for their reserves. Among the biggest buyers have been Asia's economic giants Japan and China. These two nations have long dominated the global U.S. Treasury market, investing their vast dollar reserves in American bonds to both stabilize their own currencies and finance U.S. government spending. But now, the financial world is on edge, as reports indicate that both Japan and China are dramatically reducing their holdings of U.S. treasuries. Allegations suggest that the two countries have sold as much as 45% of their U.S. bonds, raising concerns about the impact this could have on the American economy and global markets. So, what does this drastic move mean? Are Japan and China acting together in an economic alliance? Or is this simply a response to individual financial and geopolitical pressures? And most importantly, could this lead to a major financial shakeup for the United States? The role of U.S. bonds in the global economy. As Treasury bonds are a key tool the American government uses to finance its budget deficits and fund infrastructure, defense, and social programs. The reliance on bond sales has increased dramatically since the 2008 financial crisis, with Washington borrowing extensively to stabilize the economy. Meanwhile, for foreign central banks, U.S. Treasuries have historically been one of the safest investments. The U.S. dollar is the world's reserve currency, and U.S. bonds have been viewed as one of the most secure ways for countries to store their wealth for years. Japan and China have taken turns as the largest foreign holders of U.S. debt. By purchasing American bonds, they not only earned returns on their investments but also helped maintain the stability of the global financial system. However, economic and political shifts have begun changing this dynamic. China's strategy, moving away from U.S. deepened in China's relationship with U.S. debt, has been evolving in response to geopolitical tensions, trade disputes, technological restrictions, and Washington's increasingly confrontational stance toward Beijing have led Chinese policymakers to reconsider their dependence on American bonds. The fear in Beijing is that holding large amounts of U.S. debt makes China vulnerable to financial pressure from Washington. If relations were to deteriorate further, U.S. policymakers could attempt to use China's treasury holdings as leverage. To counter this risk, China has been steadily diversifying its foreign reserves. Instead of relying heavily on U.S. treasuries, Beijing has shifted its focus toward alternative assets such as gold, the euro, and the Japanese yen. There are also efforts to strengthen the yuan's global standing, allowing China to conduct more trade without relying on the dollar. Moreover, China is aware of the risk that the U.S. could impose financial sanctions similar to those used against Russia following its invasion of Ukraine. In response, Beijing has been reducing its exposure to the dollar-based financial system, preparing for potential economic conflicts with Washington. Japan's motivations, economic struggles, and policy shifts. Japan, while a close ally of the United States, has different reasons for selling off U.S. bonds. The Japanese economy has faced persistent challenges, including low growth, high public debt, and ongoing monetary policy struggles. For years, the Bank of Japan pursued aggressive monetary easing, keeping interest rates extremely low to stimulate the economy. However, global inflation and currency fluctuations have forced Japan to reconsider its strategy. A weakening yen has put pressure on Japanese policymakers to act. By selling off U.S. treasuries and converting dollars into yen, Japan can support its currency and stabilize its financial system. Additionally, rising global interest rates have made Japanese bonds more attractive, providing a compelling reason for Tokyo to shift its investment focus away from U.S. assets. Is this a coordinated move? One of the biggest questions arising from these bond sell-offs is whether Japan and China are acting together to send a message to the United States. Historically, Japan and China have been economic competitors with deep-rooted political tensions. Their geopolitical disputes, such as conflicts over territory in the East China Sea, make it unlikely that they would engage in formal economic coordination. However, in the world of finance, national interests sometimes overlap. Both Japan and China face pressure from U.S. economic policies, and both nations have strategic reasons to reduce their dependence on U.S. treasuries. Some analysts speculate that their simultaneous bond sell-offs could be an indirect warning to Washington if the U.S. continues to push aggressive policies against them. They have the power to shake financial markets. Still, most experts believe that the sell-offs are occurring for independent reasons. While their actions may have similar effects, there is no solid evidence of a secret agreement between Tokyo and Beijing. The impact on the U.S. economy. The real concern now is what these bond sell-offs mean for the United States. If major holders like Japan and China begin offloading U.S. treasuries, it could lead to significant financial consequences. Higher interest rates. The sale of large amounts of U.S. bonds would push bond prices down, leading to higher yields interest rates. This would make borrowing more expensive for the U.S. government, increasing the cost of financing its national debt. Potential inflation risks. If interest rates rise too quickly, it could slow economic growth and trigger inflation. The Federal Reserve might need to adjust its monetary policy to stabilize markets, which could have ripple effects on everything from mortgage rates to business loans. Dollar depreciation. While the U.S. dollar remains the world's dominant currency, a massive bond sell-off could weaken its value. If global investors lose confidence in the dollar, it could lead to broader financial instability. Market volatility. Uncertainty surrounding U.S. treasuries could cause stock market fluctuations, affecting investor confidence and economic growth. Washington's response. Can the U.S. counteract these moves? Given the potential risks, the U.S. government may attempt to intervene in various ways. One possibility is diplomatic pressure. Washington has strong economic and military ties with Japan, and U.S. officials may urge Tokyo to slow down its treasury sales to prevent market disruptions. With China, however, the situation is more complicated. Relations are already strained, and Beijing may not be willing to negotiate on this issue. Another option is for the Federal Reserve to step in by adjusting monetary policy or purchasing bonds to stabilize prices. However, this approach carries risks, as excessive intervention could distort markets and lead to unintended economic consequences. The bigger picture. Is the U.S. financial system at risk? Despite these challenges, many experts believe the U.S. financial system is strong enough to withstand bond sell-offs from Japan and China. U.S. treasuries remain a key part of global financial markets, and demand from other investors such as Europe and the Middle East could help absorb any sell-off. Shocks. However, in the short term, such moves could create market turbulence and economic uncertainty. The bigger concern is whether this trend signals a long-term shift away from U.S. financial dominance. If more countries follow Japan and China's lead in reducing their treasury holdings, the U.S. could face increasing difficulties in financing its debt. Conclusion. A warning sign for the future. The reports of a 45% sell-off in U.S. bonds by Japan and China have sent shockwaves through financial markets, raising concerns about the stability of the global economic order. While their actions may not be coordinated, they reflect broader trends of shifting economic strategies and geopolitical tensions. The U.S. remains the world's largest economy, and its treasury bonds continue to be a cornerstone of global finance. However, if major players like Japan and China continue reducing their holdings, the long-term implications could be significant. Whether this marks the beginning of a larger financial shift or just a temporary adjustment remains to be seen, but one thing is clear: the world is watching closely.